OptionChampion.com.
Today is Friday, August 26th. I'm Rick Adams, and this is Tricks of the Trade.
All data and other information contained throughout this video are for demonstration purposes only and shall not be construed as trading or investment advice or an advertisement for software or other trading applications, nor shall any part of this presentation be considered a recommendation of securities or other tradable products or related strategies. Trading and investing, whether short or long term, involve risks that may not be suitable for everyone. Any mention of past performance is not an indication nor a guarantee of future results, as volatile market conditions can arise at any time and result in substantial losses. No individual should make any trading or investment decisions without consulting a professional and conducting his or her own research.
Welcome to Tricks of the Trade on this last Friday in August, wrapping up a jam-packed week of economic data. New home sales fell 12.6% to 511,000 in July, the lowest level in 6.5 years, and below the median forecast of 575,000. June's new home sales will revise down from 590,000 to 585,000. Median home prices rose to $439,400 in July, an increase of 5.9% compared to June, and 8.2% compared to a year ago. Pending home sales fell 1% after a revised 8.9% decline in June. On an adjusted basis, contract signings were down 22.5% compared to a year ago. Monthly mortgages increased 32% in the second quarter compared to the first quarter and 50% year over year. July durable goods were unchanged, below the expected increase of 0.6% and below the revised 2% increase from a month ago. And for the last bit of economic data, unemployment claims came in at 243,000 for last week, down 2,000 from the revised 245,000 in the prior week. In his annual policy speech in Jackson Hole, Wyoming today, Fed Chairman Jay Powell warned of persistent interest rate hikes that will cause some pain for households and businesses. Powell's remarks sparked a steep sell-off in the Friday session, putting the cash market indices deep into the red on the week. The Dow ended the week lower by more than 1,400 points. The S&P 500 lost 170. The NASDAQ Composite lost 561. The Russell lost about 56 3/4, and volatility gained almost 5 points on the week. Crude oil gained $3.35. Gold lost $9.50. Silver lost 19 cents, and natural gas gained 6 cents on the week. Today's trade analysis is on a ratio spread in CHWY, ticker symbol CHWY. A ratio spread is a strategy that consists of unequal parts, where an investor buys an option at one strike and then sells a greater number of options at another strike, with each option leg being in the same underlying stock and expiration date. Selling a greater number of options at one strike results in a higher premium that can cover the premium paid for the fewer options at the other strike. In this case with CHWY, I put on a 1:2 ratio put spread in the September weekly cycle with 49 days until expiration. I bought one put at the 40 strike and sold two puts at the 39 strike. As with any other spread, a ratio spread can be bought or sold in multiple quantities. For example, buying 3 1:2 ratio spreads would be the same as buying one 3:6 ratio spread. I bought the 40 put for $1.84 and sold the 239 puts at $1.57 each. Selling the 239 puts at $1.57 each gave me a total credit of $3.14 on that leg of the spread. That $3.14 credit covered the $1.84 debit paid for the 40 put and left an overall credit of $1.30 on the spread. Looking at this ratio spread directionally, the long 40 put is bearish, meaning a negative sentiment where I want the stock to go down in price, and the two short 39 puts are bullish, meaning a positive sentiment where I want the stock to go up in price. By having a greater quantity of puts on the bullish side of the spread than on the bearish side of the spread, I want the stock price to remain at or above the short 39 put strike for the position to be profitable. If I hold this ratio spread all the way through expiration and the stock price is above the short 39 put strike, then my profit would be the entire $1.30 credit received on the trade, or $130 in option terms. What happens if the stock falls below the short 39 put strike? Well, that's where position management comes in. And there is something worth repeating and expanding upon with regards to this ratio spread. As I mentioned in the opening of this analysis segment, this ratio spread has unequal parts, one long put and two short puts. If we eliminate one of the short puts so that each leg is equal in size, we will see that there's a long vertical put spread embedded in this 1/2 ratio spread. A long vertical put spread is a bearish play where an investor expects a decline in the stock price. Well, in this scenario of my CHWY stock price falling below my short 39 put strike, that means there would be a profitable long vertical put spread embedded inside this ratio spread. So I would close the long 40 put and one of the short 39 puts and manage the one remaining short 39 put by either rolling it out to a later expiration cycle, either at the same strike price or a different strike price, or just assume the risk of being long the stock at $39 per share and then manage the long stock position accordingly. There will be no tricks of the trade next Friday going into the Labor Day weekend. We will return the following week. That's it for this episode of Tricks of the Trade. I'm Rick Adams. Thank you very much for watching. See you next time.